Thank you for joining us today. This is a especially interesting time to have an opportunity to conduct a review. Market sell-offs are never pleasant, but they are absolutely necessary evils of the market. Longtime clients of mine and I probably can't count how many times we've been in situations like this, but they all have very natural patterns, and they're important to understand. So the human nature aspect of it, we want to understand what's causing it. In this case, there's not really a single specific issue, but a long laundry list of them. And while it's interesting to sort of pursue that and understand the driver of market volatility, it's more important, arguably, to understand the natural patterns that take place. Nobody knows exactly when, but ultimately markets that sell off recover. And once they've recovered, they will move on to higher ground. And that's exactly what every investor should be thinking in the midst of any sort of sell-off that takes place. It's also very critical to stay focused on what we can control. So we can't control the overall market volatility, but we certainly can control how we're positioning accounts with respect to size and style and the nature of the stocks that we're selecting via our process. And so the point of our session today is sort of to do that review, and Adam's going to take us through that on sort of the macros of the market, and then we're going to get into specifics, and Andy will lead that in terms of exactly how we're going to position accounts to maximize the opportunity in the year ahead. So Adam?
Thanks, Lowell, and hello, everyone. I want to, I know this is timed for the quarter, but I want to take a look at what happened across various asset classes, both for the calendar year, but also for the last quarter of the year, which is where most of the action took place in terms of volatility. So what I have here is a chart and let's call it a heat map of what we consider to be the 6 broad asset classes in the market. So we've got the 4 buckets on the left representing the various components of the global equity market. We've got the U.S. stock market, developed international markets, emerging markets, the global real estate market, and then on the right-hand side, the bond market, both domestic and overseas. And what I've got here for calendar year 2018 is the various returns of each of these asset classes, and you can see the red on the equity side of the map, and this was the first negative year in the domestic stock market that we've had in quite some time. During our last quarterly call, we discussed just being on the cusp of a 10 consecutive year positive clip for the S&P. And unfortunately, we just missed out on that with what happened in the last quarter. But you can see clearly that the domestic market held up quite a bit nicer than the overseas market. Some of this is currency driven. A lot of this is economic and driven by politics overseas, but certainly not the prettiest picture from a 40,000-foot view in terms of the overseas markets. But on the right, you can see, the bond market, despite concerns about rising interest rates in the front half of the year, the bond markets held up and were domestically pretty flat and slightly positive overseas. And for context, and a lot of what we're going to talk about today is going to be, discussing what's happened, but also putting it in the historical context. You can see down below for each of these different asset classes what the average return has been over the last, really since 2001, the best year, the worst year. And this helps you understand the dynamics and the upside and the downside potential of each of these asset classes. So the percentage of exposure you should have into each of these categories is a function of many different things, but this helps you understand, at least from an investment landscape perspective, what transpired. And looking at the quarter, you can see, the same formatting of the numbers here, same categories. You can get a good understanding of what happened from top to bottom from the start of the quarter to the end of the year. And you had double-digit dips in domestic and international developed markets, and in the emerging markets and the REITs, the real estate markets held up a little bit better. And a lot of that's, some of that's a function of where things were coming into the quarter. But the sell-off certainly impacted all major equity categories. And during that sell-off, you did have a little bit of a cushion from the bond market with interest rates falling as that was transpiring. So that helps us understand in the short term what has happened. From our perspective, volatility does bring on opportunity for us to take some level of control even when the markets are uncontrollable. And we saw that transpire in the form of tax loss harvesting across client accounts. So whenever you have losses in the short term in markets, you have the opportunity to review individual equity positions in your portfolio and your taxable accounts and say, where was I from a gain standpoint coming into this point of the year? And can I take losses to offset those gains? So that was something that we were looking at pretty diligently the last 2 months of the calendar year. And it also gives us the opportunity to replace positions that we feel are no longer in favor or no longer meet our criteria with other names that are more attractive and give us the opportunity to rebalance. And so, while it's unpleasant to see drops in the market, it does, as active managers, give us the opportunity to take some control in client accounts. And what this means from a long, even an even longer term perspective is, just to look at the characteristics of these different, the same 6 categories, but understanding what happened over the past year, but the rolling 5 and 10 years. You can see, and this is pretty relatable to many 5 and 10-year intervals through time, where you have short-term volatility, but you exchange that for intermediate and longer-term upside potential. So you can see the last 10 years, especially, the big theme has been the rise of the U.S. equity markets. International and emerging markets have been, high single digits, but have certainly lagged domestic markets on that front. And the bond market has, delivered what it historically delivers on average, is low to mid single digit returns. And so some of the things that we've looked at, while this was transpiring, obviously, there were a handful of factors that anyone could point to and say this is what caused the shorter term sell-off in markets. You had trade concerns, you had the Federal Reserve and their timing and the magnitude of interest rate increases, and then certainly we've got let's call it a more volatile political environment than what we're accustomed to. So these are really the 3 main things that we think have been contributing factors, but these are factors that didn't just pop up and appear overnight heading into the fourth quarter. These were things that were lingering, and for many of them throughout the course of 2018. And so that's, I think, one of the themes you'll hear Andy and myself hit on is that this is a fundamentally sound economy and now certainly a more attractively priced stock market. And so those shorter term variables and the timing of when they decide to impact equity returns, for us doesn't have a meaningful or material impact on the long-term prospects for markets. A lot of this comes down to timing, and this is a popular chart that we have here, an updated version to include 2018. But you hear a lot about the randomness of asset classes returns in the short term, and this goes back to 2009. You can see really a ranking each calendar year from the best performing to the worst performing asset class for each year. And on the very far right, we've got the 10-year cumulative average, or the average for each of these, and then re-ranked. And you can see in these short-term windows and these annualized windows, there are years where some asset classes are the top performer, then middle of the pack, then the worst. And it's this rotating theme that happens from left to right. But what we really notice is that, when you look over many 10-year intervals and through time, there are certain asset classes that have risk embedded in them that reward investors over the long run, regardless of what happens in shorter windows. So small caps, mid and large cap, representing the domestic markets over this 10-year period being the top performers, double digit. These are, we would say, above average rolling returns for a 10-year window. And a lot of it has to do with where you start. This starts with the bottom of the financial crisis and takes us to where we are today. So a lot of this captures the recovery of these asset classes through a historically poor market period. But this puts some context and helps understand what are the segments and the components of the market, and how have they been behaving through time. And this will, I've touched on this a little bit already, but this is some additional bullet points on, reasons or drivers of the sell-off. We talked about the trade conversation, interest rate, the conversations and movements throughout the year. Globally, there's certainly a close monitoring on the overseas economies, especially China. With the trade discussions, everyone's trying to be the first one to gauge what's the impact on the economic prospects for the U.S. and China, given the trade policy that's been implemented. So anytime there's economic numbers reported, or we go through an earnings season, everyone's looking for that buzzword trade. The last item is they call this the flattening of the yield curve. So if you look at the yields of U.S. Treasuries, typical benchmark yields are 2-year, 5-year, and 10-year yields. And what the investment community is often looking for is what's the spread? What's the difference in the 2-year, the 5, and the 10-year yield? And oftentimes there's debate around the flattening of the yield curve, meaning the 2 and the 5-year yields specifically, and then the 10-year, they line up so that they're all very similar. They call that a flattening of the yield curve. And when that happens, again, there's debate around whether or not that's an indicator of a recession or a slowdown in the economy. So as the Fed's raising rates, people are looking at what is the impact that this has on the yield curve, and what might that signal in terms of the economy. But again, going back to this theme, the fundamentals of the economy were sound before and after this recent sell-off occurred. So that's something we remain very upbeat on. And as Andy will show in just a second here, we can discuss a little bit about, within our strategies and within our size and style of rotation, what we're doing and how we're positioned heading into to 2019. So I'll pass it to Andy.
Okay, thank you, Adam. Yeah, so as Adam sort of touched on and mentioned, next we're going to cover key factors impacting our size and style responsive U.S. equity strategy, our stock selection model, as well as things we are looking forward to in 2019. So to start, there's no question about it, the fourth quarter was a bad quarter across each size and style market segment. Small caps, which had been running as much as 3 times ahead of large caps earlier in the year, sold off the most in this quarter. Small caps often do worse during market downturns as they are riskier than their large cap peers. However, large caps didn't do great themselves. Small caps certainly got to that 20% bear market line, and I know at one point large cap stocks were flirting with that line as well. So it was a pretty stark difference from what we saw earlier in the year. Talking about year-to-date returns, almost every segment was negative except for the large growth sphere. This sphere is kind of driven by the mega cap growth information technology stocks. Think your Netflixes, your Microsofts, your Amazons. Those are really the only types of stocks that ended up doing well on the year, and it reflects here, on the year-to-date returns. So as we've covered before in this webinar, what it means to be size and style responsive is to invest in the size and style segment expected to outperform ahead. So while we would prefer to be tilted towards small cap stocks and towards value stocks due to the long-term premiums that those types of stocks earn, the size and style returns are cyclical when viewed over a long enough time frame. This creates opportunities to take advantage of both growth and value and large and small cap phases. So these next few slides we're about to show will illustrate our thinking on where the market is going and where we are tilting our portfolios. Starting here with size. So this chart presents the rolling 3-year return differentials between small cap and large cap stocks. When the line is moving up, it's a pro small cap time frame, and when the line is moving down, it's a pro large cap time frame. We've been cautious making a strong call with regards to size because the long-term trend has been sideways here recently. While large cap stocks did end up outperforming small caps over the course of the year in 2018, there was a time in June where small caps were greatly outperforming large cap stocks, as we touched on earlier. Even as recently as September 30th, the end of the third quarter, small caps held a relative return edge over large caps. So as you can see, with large caps and small caps trading off which segment holds the return edge, there hasn't been any established momentum either way. So while earlier in the summer we thought that we might see a little bit of small cap momentum establish itself, we are currently targeting a neutral weight to the size factor until we see evidence of momentum one way or the other. Next is the rolling size cycle chart. Style chart here. So this is the one-year return differentials between value and growth stocks. And similarly, when the line is moving up, we're in a pro-value phase, and when the line is moving down, we're in a pro-growth phase. So while we have been cautious on our size bets, we've been tilting fairly aggressively towards growth for the past 18 months, and we continue to tilt in that direction. So earlier this year, we did see a brief counter trend actually towards value stocks. And counter trends like this are fairly common during market phases, but they don't necessarily signal the end of a cycle. So despite that counter phase, we saw evidence and momentum return to the growth stocks in the market. And by the end of the year, by the end of the year, there was a 9% performance edge for growth stocks over value stocks in the large cap sphere, and a similar edge in the small cap sphere as well. So next, we want to show what our current size and style breakdown is in our portfolios versus what would be considered neutral. So one quick point here. When we're talking about a neutral breakdown, 75% of the market as a whole is comprised of large cap stocks, and 25% comprise the rest, the mid and the small cap stocks. So when we're talking about being neutral with regards to size, we're neutral from a market cap weighted perspective. So that means 75% large and 25% small and mid. When it comes to style, we split that right down the middle, 50-50. So the pie chart here on the right shows what our neutral size and style breakdown would be. And on the left, you can see where we currently are. So we're tilted more heavily towards growth stocks for sure, and you can see that in the large blue blob there. That is a large growth allocation. And with more of an emphasis here on growth companies than value companies. So we show, we cover size and style positioning first, because that's the primary value add of our strategy. But stock selection plays a valuable role as well. So over the past roughly 2 or 3 years, you could describe the market conditions as risk on, which has negatively impacted stock selection returns based on our model. So what we've seen is sort of an unusual time frame where factors that are widely shown to drive long-term returns, such as value, profitability, and quality, have correlated the wrong way. So what this means is companies with expensive price multiples and maybe poor profitability were outperforming higher quality companies that generate consistent earnings at a reasonable price. So a big positive sign, if we can take any positives away from that fourth quarter, is that we saw a return to normalcy in how these factors correlate to returns. So once again, we're seeing the value factor especially be rewarded by the market. And our stock selection process does rely, even in the growth sphere, on companies that are priced at attractive valuations. So whether we're talking about growth stocks or value stocks, the return of value factors in correlating the wrong way is a tailwind to our stock selection process. So this is something that we've seen continue here in January, and it's something we're excited to see, a return to normalcy on this front. So on that vein, when we look ahead to 2019, there are a couple key things that we're looking at. So as I just mentioned, the improving factor correlations is something that we're excited about and hope to continue to see into 2019. A return to a more normal market environment is something that we've seen so far here in January as well. The second key point is, will mega caps continue outperforming everything else? So this is maybe a bit of an esoteric point, but most market indexes are cap weighted. And what this means is the larger the company, the more weight and the more pull it has in the index. So if you compare the S&P 500, which is cap weighted, to the equal weight version of the same index, there is a large gap in performance differential. So in the over the course of the year, on a price return basis, the S&P 500 was down 7%, when viewed from a market cap standpoint, but if you were to equal weight every single stock in the index, the S&P was actually down 12.5%. And this is because the top 10 holdings, or really the largest holdings in the index, did a lot better relative to the rest of the stocks. And to give you an idea for the difference here, the top 10 stocks of the S&P 500 comprise 20% of the index, leaving the rest of the remaining 490 stocks. So you can see the pull that the very largest stocks will have in the index. And what we know from looking at history is typically larger stocks reach a point where it's difficult for them to continue growing at fast clips. And their earnings and returns as a result end up regressing to the mean. So if history is any guide, we will begin to see some of these mega cap stocks start performing more normally again. And in fact, we already saw evidence of that in the fourth quarter. While everything was selling off, there was no difference between the equal weight and the market cap weighted S&P 500. So there is some evidence here that some of the other stocks are beginning to perform more similarly to the very largest stocks. Whenever we're in a time frame where mega caps are outperforming, that's a difficult environment for any active manager. So a return back to a more diverse set of companies contributing to the index will hopefully be a good thing for us. All right. So when will the market rotate towards value? So we saw that style cycle chart earlier, and this growth phase has been about the magnitude that we would typically see in a growth phase, and it's beginning to get to be around the right amount of time too. So while the trend still isn't pointing towards value, and the fundamentals are beginning to paint a little bit of a different picture, that maybe some of the most cheap stocks out there are at a larger gap in valuations relative to the most expensive stocks. And while valuations alone are not a good timing mechanism and don't necessarily predict what's going to happen in the short term, we would expect, based on what we've seen in the past, eventually a turn towards value happening as soon as sometime in this year. So January, growth stocks have held the edge. They've continued to outperform value stocks, but we're going to continue watching this very closely to see if we get a turn in that trend. And of course, there are several macro items to keep an eye on. These are the things that Adam touched on earlier. There's not really anything any of us can do about them, and these are going to be the things that are likely in the headlines going forward. And to Lowell's point about things we can control versus things we can't control. We can't control what's going on with the Fed or global growth or U.S. policy, but we can control our own action. So it's important to know what's going on in the world, but not necessarily letting these things impact your investments. And that brings me to the final slide that I'm going to have before I pass it on again. And this is what we wrote in the last quarter. So obviously a lot happened in that quarter, and a lot happened between these webinars. So we wanted to keep everyone updated on our blog with what our thinking was. So in case you missed it, you can go to bernie.com/blog to find these pieces. So back at the very beginning, when stocks were selling off, we wrote about what's happening in the stock market. And then ahead of the Fed's interest rate decision, which created more uncertainty, we explained why the Fed was likely to keep raising interest rates, at least in the fourth quarter. So if you want to get an idea of what kind of data the Fed is looking at and what drives their decision making, we explain it all in that post. And then we talk about Roth conversions and how that might be a tax strategy tool for clients. But the piece I really wanted to focus on here is a piece that we wrote really in December when things were, selling off the most, and it's actionable strategies on dealing with market sell-offs. So one of the key value adds of having an advisor is having someone you can talk to when things start going poorly in the market, so you can continue that confidence to stay invested. And the thing is, recency bias makes it feel like whatever is happening right now is the only thing that ever happens, right? So when we're in a period where markets are selling off like crazy, it's hard to imagine a period when things are, rosier. And then when you couple that with the fact that we as humans feel the pain from losses more so than we enjoy gains, it's easy to see how investors might pull out of the market during a sell-off. Now, most of our clients were, they kept the faith and they kept going through the market sell-off, which ultimately is the way to achieve long-term returns promised by stocks. But there's a few things to keep in mind when stocks are selling off. For one, or even before stocks are selling off. For one, expect volatility, right? As was mentioned earlier, volatility is the price investors pay for the return premium from stocks, all right? So that's first and foremost. And the second thing is we should really avoid frequently checking our investment accounts. So we got a little bit of pushback on this point actually in the blog post from some of the feedback we got. But the truth is there's evidence that suggests that investors who frequently check their accounts perform worse on average. So, you certainly want to be looking at your investments to make sure things are staying on track. But if you're checking more than, once a quarter, you might be checking too much. And then the third thing is, if you truly are losing sleep and you can't stomach watching your accounts go down and you must make a change, make a small change rather than a wholesale change. So, the choice doesn't have to be 100% invested or 100% in cash, right? If you think you're too aggressively positioned in the middle of a sell-off, make a small change to a portion of your account to get more conservative. And then the key thing is when markets settle down, revisit your asset allocation with your advisor because it may be the case that your asset allocation is not the right one. So now is a good time. We've had not a complete recovery, but a pretty good recovery from the bottoms down on Christmas Eve. So now would be a good time to make that call to your advisor just to check in to see if your allocation is correct for you. All right, and with that, I'm going to turn it back over to Adam to wrap us up here.
Thanks, Andy. Yeah, we'll summarize 3 key themes of the discussion today that we want to leave everyone with on a positive note. The big one being that, again, we've said this multiple times, we feel like the prospects for the economy remain very strong. Valuations in the equity markets are attractive. They're actually, if you look at the current PE ratio of the S&P 500, it's around 20, which is the cheapest the market has been, relatively speaking, since 2011. So I'll say one benefit of a pullback or a dip in the market is that it resets expectations and it helps better align the markets with the current fundamentals of the economy. So a great scenario from our perspective is when you have as we see in point 1 here, a strong economy combined with point 2, more attractive valuations. So last year, you heard a lot about the health of the corporate earnings that were reported both on the top and the bottom line. Many factors are driving the positive prospects right now economically. So again, none of those have really removed themselves from the picture. So we're in a good position coming into the year with a reasonably priced market with a strong economy. And then while this is happening, it does certainly not mean that volatility will remove itself from the equation. Just like we saw at the end of last year, volatility will periodically flare, but this does not impact the long-term prospects for investors. As we saw, as we looked at asset class returns over 1, 3, 5, and 10-year periods, the price that we pay for those attractive long-term equity returns is certainly embedded, or part of that being the volatility we have to experience in the short term. So in a phrase that was used by a long-standing PM here at Bernie Company, keep the faith. Keep positive. Don't get overly distracted with the flow of the news and the news of the day. Certainly we understand it's concerning, and that's why we're here to speak with you as needed to understand your situation and to better align your investments with that. But for the long term, keep invested, keep the faith. And we appreciate your time, and this will be recorded for viewing as well in the future. So thanks, everyone, for tuning in.